In fact, for those who are aspiring for the career in the area of banking and finance, hi, financial management is one of the most sought after course in the area of economics. In fact, for those who are aspiring for the career in the area of banking and finance, financial management is a must learn area. Well, money is something that we quickly recall for the discussions on finance or financial management. Of course, we're not wrong. In fact, the entire domain of financial management revolving around finance or financial management is on money. I'm very sure at individual level, we all know what is finance, how finance works in real time. But with the help of this course, let's try to put our understanding of financial management into a perspective so that your journey of understanding financial management in the advanced levels would be smoother. So why delay? Let's begin our journey. Welcome to the course on Introduction to Financial Management. My name is Pawan Kumar Chandrappa. So in this course, we will be discussing the concept of finance, the definition of financial management in business, the goals of financial management. We also discuss the scope of financial management, the functions of finance manager, the agency relationship, which is one of the most important topic to be discussed in the area of financial management. We discuss about it, the agent and principal relationship. And we also talk about the financial system. We talk about the entire ecosystem of financial system and how each component in the financial system are interconnected. And we also talk about the safety of investments in business. Well, we have a lot to understand. Let's begin our journey with the first topic, the concept of finance. The concept of finance is basically originated from economics. So, what is economics? How an individual or a business or a government making use of these limited resources to fulfill the unlimited dreams or unlimited desires is all about economics. So that's the underlying principle of economics. So the concept of finance is derived from these notions. So basically, when we talk about finance, we talk about cash, we talk about banks, investments, loans, funds, and we talk about forecasting. So forecasting the need for money. We talk about borrowings, where to borrow, how much to borrow. We talk about investments, and we also talk about budgeting. So what is budgeting? So budgeting is all about choosing an investment alternative. There are so many investment alternatives. Which one is the best project? Which is the best project to invest in? So choosing the best alternative. So this discusses about budgeting as well. Basically, finance is an art or science of money. We said money is the epicenter of this entire discussion of financial management, of course. Well, when we say finance is all about money, we need to understand finance is also, it's an art of managing money. It's a science of managing money. So why we call finance is the science? We call the finance as science because finance dependent on certain principles for deriving the results. For example, when we talk about the time value of money, we dependent on a compounding or discounting principle, right? We talk about conversion of present value of money into future value, or we talk about conversion of future value of money into present value. So there are certain principles on which the finance is actually dependent. So that's the reason we call finance is the science, because there are certain procedures to be followed to calculate the values. So that's why we call finance is the science. At the same time, we claim that the finance is also an art. Why finance is an art? Because when we are doing a calculations, when we are analyzing the money, we need to, understand it is purely based on the skills and abilities of an individual, how to analyze the financial transactions and how to interpret them, how to report them. So it is an art. So it is completely dependent on the individual who is actually conducting this analysis of the financial results or the concepts that are related to finance. So that's the reason we call finance is also an art. Let's jump into the next level of discussion. What are the broad areas of finance? Basically, the finance can be discussed under three important categories: personal finance, business finance, and then public finance. So these are the categories in which we discuss the area of finance. What is personal finance? Is it something related to an individual? Yes. Personal finance is about how an individual earns some money, how an individual is earning money, how income is coming to him or her, what are the sources from which an individual is earning their money. For example, when we talk about personal income, there are 5 different heads, right? So 5 important heads: income from salary, income from house property, income from business or profession, or income from capital gain, income from other. Let's jump into the next level of discussion. What are the broad areas of finance? Basically, the finance can be discussed under three important categories: personal finance, business finance, and then public finance. So these are the categories in which we discuss the area of finance. What is personal finance? Is it something related to an individual? Yes. Personal finance is about how an individual earns some money, how an individual is earning money, how income is coming to him or her, what are the sources from which an individual is earning their money. For example, when we talk about personal income, there are 5 different heads, right? So 5 important heads: income from salary, income from house property, income from business or profession, or income from capital gain, income from other sources. So these are the sources from which an individual is earning money. Now, these are the sources of income. Finance talks about how an individual is actually earning from these sources, how money is flowing to his bank accounts. The next thing is spending. How an individual is spending. Let's say he has earned 1 lakh, and how is spending 1 lakh, right? So spending on, for what reasons is spending? Is he spending for medical expenses, or is he spending for investments, or is spending for daily cash requirements, or is spending for to buy any long-term assets? So that is the spending pattern that we analyze in finance, in personal finance. Well, we understood there is an income, there is a spending. Now, let's assume the income is more than spendings. Let's say he's earning 1 lakh and he's spending, say, 80,000. So 20,000 is something that is called saving. This is the surplus. Now, with the surplus, what is he doing, or what is he or she is doing? Is he or is she saving this money and keeping it in the bank deposits, or how she is making use of that money? Is she investing this money, or is she buying some long-term assets? This all is discussed under personal finance. Now, let's say the income is lesser than the spendings, right? So let's say the income is 80,000, the spendings are 1 lakh. Absolutely, there is a deficit, right? There is a deficit of 20,000. So how an individual is matching this deficit? From where is bringing that money, right? He may have to go for borrowings, right? He may have to borrow money from the other sources to fill this, to bridge this gap of income. Earning is 80,000, spending is 1 lakh. So 20,000 is the deficit. So that is the discussion of personal finance. So how an individual is managing these deficits is the discussion of personal finance. Well, when there is an income, when an individual is earning cash, he need to pay the tax. Every individual is supposed to pay the tax. So how much of taxes he's paying, on what areas he's actually paying taxes? Is he paying income tax, or is he paying business taxes, or is he paying sales tax, or is he paying any other taxes or gift tax or whatever? So that is the part of discussion in personal finance. Again, there is something called a retirement. Again, for every individual there will be a retirement, right? So how an individual is planning for the retirement? Is he spending everything he's earning, or is he saving some money for his retirement? So that is the discussion of personal finance. So retirement planning, is he investing in long-term investment options, where he's investing in bonds or debentures, or is investing in long-term assets to earn the long-term returns? So that is the discussion of personal finance. That is part of personal finance. Well, so these are the things that we discuss when it comes to personal finance. Now, business finance. As the term business finance reflecting business, how a business is dealing with finance, how the business is handling the financial aspects. Well, every business will have cash flows, cash inflows, and cash outflows. So what is cash inflow? The sources of money. So what are the sources from which a business is earning money? Or what are the sources from which the business is borrowing? Let's say when the business is good, the business may be making profits, and these are the cash inflows. These are the positive cash inflows, right? So when the business is expanding, how a business is catering the needs, the financial needs of the business, right? So from what are the sources the business is borrowing? So that is the discussion of a business finance. So what are the sources of finance? So what are the applications of finance? So how the business is borrowing money, how business is getting cash flows, and how business is making use of those cash flows. Financial decisions, right? So how to bring money, what are the financing decisions? Let us say the business has some money, the excess money, how business is investing that money in the market, for what rate the business is investing money in the market. So that is very important area of discussions in business finance. The dividend decisions. These are some of the very critical decisions for a business. So how to pay dividend, how much to pay, at what intervals the dividend needs to be paid. Of course, there will be regulations in each country at what intervals they need to pay the dividend, but it is up to the decisions of a company to pay or not to pay the dividends. Taxes. Every company is paying the taxes, right? So there is no exception for any business. At least in India, businesses are paying taxes. There is a separate corporate tax which they're supposed to pay, and it will be revised every year. So that is the discussion of business finance. So operating and marketing decisions of a company. So what are the operating decisions? What are the operational aspects of the business? And we talk about the marketing aspects, how money is required for marketing activities. And also the accounting aspects are very much part of the business finance. CSR. Corporate social responsibility. So business, it is not just about earning profit. They also have certain social responsibilities, social obligations. For example, taking care of children's education in the poor societies, or to take care of the parks or the roads or the bridges, the construction or maintenance of those, or to take care of orphanage houses, or to take care of any social activities which are at the larger cause for the society. So that is also part of the discussions in business finance. Well, the third important area in finance is the discussions on public finance. So what is public finance? How a particular country is managing the money, how the country is managing its financials, right? How a country is handling the demand side of the economics or the supply side of the economics, how the prices are managed. Because we all know price is the intersection of demand and supply. So how a country is managing these aspects how a country is managing inflation. So, what is the inflation level in the country, and what is the healthy inflation rate that is required for a country to grow consistently? So, that is also part of the discussions in public finance. So, with inflation, there is also discussions on GDP, the gross domestic product, the budgeting, the forex, foreign trades, and reserves. These are also part of the discussions in public finance. Now, financial management in business. So we have understood how financial management or finance works in individual's life or in aspect of country, but we'll dive deep into understand what is financial management in business. Basically, financial management in business is it's an application of management principles in financial activities. It is an art or science of managing money to meet the predefined objectives. So basically, it is the process of planning, organizing, controlling, monitoring financial resources with a view to achieve organizational goals and objectives. So every organization will have certain set of objectives, and to achieve those objectives, there is a need for financial resources. So how a business is handling these financial resources to meet those objectives is the discussion of financial management in business. In business, financial management is the process of handling a company's finances in a way that generates value for the overall business. Remember, financial management is a organic function in every business. There will be a dedicated department to take care of the financial aspects of a business. So they take care of all transactions. They analyze all the transactions. They do projections for the business. They analyze the requirement for financial resources, right? And the person who is responsible to take care of the financial activities is generally called as a financial manager. Of course, there are different dimensions to see the financial manager. There are various titles in which we can call the financial manager, of course, but the roles and responsibilities of finance department is all about taking care of cash inflows and cash outflows. At strategic level, financial management is all about planning cash inflows and cash outflows. How company or a business is planning the cash inflows and cash outflows is the discussion at strategic levels. At tactical levels, financial manager or the people who are responsible to take care of financial aspects at the ground level or the entry level is to record the transactions, business transactions, analyze and produce the report for in front of the management to take strategic decisions that are related to the business. So that is at two different levels we can see in an organization. Now, it's very important to understand what are the goals of financial management. There are three. Now, it's very important to understand what are the goals of financial management. There are three important goals for financial management: profit maximization, wealth maximization, and improving market share. Of course, there are a series of goals for financial management, but ultimately, all those things will boil down to these three important goals: profit maximization, wealth maximization, and improving the market share of the business. So, what is profit maximization? Profit maximization. You all know a business is an economic entity which is running to make profits. There is no business on the planet Earth which is running for charity, right? If it is purely running for charity, then it is not called as business, it is a charitable organization. When it is a business, they need to earn profit. Why they need to earn profit? There are various reasons why they need profit. So what is the profit in business? It is simple. Revenues. What is the revenue? What is the excess of revenue that business is earning over the cost? Let us consider a business is generating 10 lakhs of revenues for this year, 2022. The cost of producing that product or service is, let's say, 6 lakhs. The remaining 4 lakhs is the profit for a company. Now, this 4 lakhs, what is the kind of profit it is a different discussion altogether, right? It may be profit before tax, right? PBT, right? This is profit before tax, profit after tax, earning before interest and tax, earning before tax, depreciation and amortizations. So what is profit before tax? This is the tax. This is the profit before deducting the taxes, because every business is liable to pay the taxes to the government. So before deducting taxes, what is that company has is profit before tax. What is profit after tax? It is, of course, it's a self-explanatory. Profit after paying the taxes to the government. Earning before interest and tax. Remember, every business will have financial obligations. Let us say when the business has borrowed some money on interest basis, they're supposed to pay the interest. So what is the revenue? What is the earnings before paying interest and taxes? That is EBIT, earning before interest and taxes. EBITDA, earning before tax, depreciation and amortizations. Remember, if it is a tangible asset, a business apply depreciation. If it is intangible asset like copyright, patent, they'll apply amortization. So depreciation and amortizations are most common in any business, right? So what is the earnings before tax, before depreciation or before amortization? So that is earning before tax, depreciation and amortization. So it's need to be very clear what is the profit that we are talking about. Now, how a business can increase the profit? A very important term, profit. By increasing the units sold, by increasing the number of units sold, increasing the price per unit, price per product, price per service, cost minimization, reducing the cost, or maybe locating new investment opportunities, or maybe acquiring new business ventures in the same line of business, or maybe from the different line of businesses. Or it may be an expansion business, expansion of our existing business. So there are various other ways to earn profit. Well, the theory of profit maximization is appreciated by many scholars. At the same time, there are criticisms too. So what are those appreciations? What are those favor towards profit maximization discussions? There are certain arguments that says, yes, profit is important for a business. At the same time, there are criticisms which we will see a little later, right? So now, what are the arguments that are in favor of profit maximization theory? The very reason why business exists is for profit. The basic purpose of business is to earn profit. In fact, profit is considered as the meter for determining the success, right? So with profit, the business is considered successful and on track. And if the profits are not there, business is considered is a curse, is a sin for the society, right? Many times, profit is essential for the survival of a business. Only when the business is able to make profits, they can survive the competition, they can survive in the dynamic business world. Only profit-making business can think of tomorrow. Only profit-making company can create future, right? That is the reason profit maximization is very important. And also, we need to understand profit is accepted by the society as long as the profit is earned in a legitimate way. For example, the profits are earn with legal routes, it is accepted. The society is okay as long as it is win-win for the society, win-win for the business, for the employees, for the stakeholders, to the customers, right? For everyone. So there is no problem earning the profit. It is required. It is very important. And society considers it is not a sin as long as it is legitimate. There is also an argument that a business which is loss making is a burden to the society, right? A business which is under huge losses, they may not be able to pay the salaries, they may not be able to pay their stakeholders, they may not be able to pay their suppliers, they may not be able to pay dividends, they may not be able to pay taxes or interest on the borrowings, though ultimately they'll become a sin or they may become burden to the society. These are the in favor of profit maximization. These are the arguments in favor of profit maximization. Now, there are certain arguments where profit maximization is criticized. The very important argument against profit maximization is the profit is not clear. So what profit are we talking about? Are we talking about net profit, or we're talking about the gross profit, right? We're talking about profit before tax, or we're talking about profit after tax, or it is earning before interest and tax, or it is profit before interest, tax, depreciation and amortization. So what profit are we talking about? It's not very clear. So when we say the ultimate goal of financial management is to maximize the profit, which profit the business wants to maximize? So that is not clear. So that is a criticism against profit maximization theory. Duration. What is the duration for which profit maximization goal is set? Is it long term or it is short term, say 1 year, less than 1 year? Many a times, businesses are compromising on their long term profits when they are focusing too much on the short term profits. So that is the sin. That's a very, unwanted sign of profit maximization goal. Scale factor. Synchronization between size of the business and volume of profit. Many times you would have heard that the cost of setting this business is, say, 10,000 and the profits we can expect from this business is 1 lakh. Don't you think it is something unusual? Your investment is just 10,000 and you're going to earn 1 lakh. And there is a smell of illegitimate activities in the business. You just invested 10,000 and you are saying you are going to earn 1 lakh. How is that really possible? Because when a business is investing 10,000 or 10,000, a business may expect 30% or 40% or 50% returns, considering the risk return factors, right? How are you able to make those many times of your initial investment? So that is something, is a very big question mark when it comes to profit maximization. Consideration of time factor. Are we considering time factor when we talk about profit maximization? The question is unanswered. The profit maximization focusing only on maximizing profit. What is the time duration we are considering to earn that profit? Is it 1 year, 5 years, 10 years, 20 years? What is that? Is unanswered. That is a criticism on profit maximization theory. Undue aggression towards profit maximization may lead to the social evils. When a business is too focused on making profits, when they're very aggressive about making profits, there will be scope for corruption, quality drop, mis-selling, false promises, undue influences, right? So it may lead to all those things. It ignores risk associated with profits. What is the risk associated with profit? Remember, risk and reward are two faces of a single coin. So what is the risk we are going to take to earn the profit is not discussed under profit maximization theories. Wealth maximization goal. So very important, very popular goal of financial management, wealth maximization. And this is one of the most, the recent approach towards financial management. And it is popular too. When it compared to profit maximization, wealth maximization goal looks very attractive. So before we understand what is that is catching the attention of the corporate world, let us understand what is wealth maximization. What is wealth? Wealth maximization is basically an increasing the value of business to increasing the value of shares held by the stakeholders. When we say stakeholders, who are the stakeholders to the business? There are two important categories in which we can segregate, we can classify the stakeholders. External stakeholders, internal stakeholders. Who are the stakeholders who are external to the business? Creditors, governments, suppliers, tax authorities, customers, media, and the society. So these are the people, these are the entities which are outside the business. They're outside to the business. They're not insiders to the business. Now, who are the insiders to the business? Insiders to the business may be shareholders, managers, board of directors, and employees. So these are the people who are internal to the organization. So value of these stakeholders is to be increased. How? Through wealth maximization. We're talking about wealth. So how? What is wealth? Basically, wealth maximization means increasing the price of the share or ensuring the dividends are paid to the shareholders. Let us say I have invested rupees 100 in a particular share. After 1 year, company is declaring a dividend of rupees 10. That 10 is the value. That's a value maximization. Now, let's say the price of the share is 100. By the end of this year, the price of the share is, let's say, 120. So this 20 is the wealth. That is a wealth that is created by the business. So wealth is maximized. The share price is increased. We calculate the wealth of a business through various techniques. So one of the ways to calculate wealth of a business is through NPV, net present value. So what is net present value? Net present value is the present value of benefits minus present value of all the costs. Right? So that is a calculation of wealth. Now, what are the arguments in favor of wealth maximization goal? So it takes care of larger interest of the stakeholders. We're not talking about profit, we're talking about wealth, increasing the value of stakeholders. So it takes care of larger interest of the stakeholders. Wealth is based on cash flows, not on profits. In profit maximization, we talk mostly about the profit. We talk about profit before tax, profit after tax, EBIT, earning before interest and tax, profit after tax, right? So these are the aspects we discuss the profits. But in wealth, we're not talking about the profits. We're talking about the cash flows, how much cash flows the business is able to generate. Long-term perspectives rather than the profit maximization goals. When we talk about profit maximization, we talk about how to increase the profits. When we talk about wealth maximization, we talk about how to increase the value for stakeholders in the long run. Remember, profit is looked for the short run. Wealth is looked at the long run. A consideration of time value of money, wealth maximization goal do consider time value of money. The rupee earned today is worth more than the rupee that would be earned tomorrow, right? So it gives weightage to that principle. Wealth maximization goal considers risk and uncertainty factors and help board members to create consistent dividend policies. Well, so these are the favored arguments of wealth maximization goal. Now, there are certain criticisms on wealth maximization also. So what are the criticisms on wealth maximization goals? It is prescriptive idea, not a descriptive idea. So creation of wealth for the stakeholders is just prescriptive, just prescribing that wealth of the stakeholders need to be increased. How to increase this wealth of the stakeholders is not discussed under wealth maximization theories. Wealth is not socially desirable. This is one of the most debated criticism on wealth maximization. So why it is not desired? Why it is not appreciated in the society? There are various reasons. The wealth should not be concentrated on few hands. When a business is concentrating on wealth maximization, the wealth will be concentrated. For example, when we say the business is dominated by major players in the corporate world, let's say we talk about Alibaba, we talk about Elon Musk, we talk about Bill Gates, we talk about Ambani, right? We talk about Mark Zuckerberg, right? We talk about many others who are actually are the legends in the business and who are creating wealth. So what is happening? The wealth of the world is concentrated on a few hands. It is concentrated. When the wealth is concentrated on a few hands, what will happen? They'll destroy the competition. They may destroy the competition. They may ensure there is a dominance of their business in the entire industry. And ultimately, that will cause serious problems for the end users, the customers. So that is one of the arguments put forth why wealth maximization should not be a consideration for financial management. Of course, there are debates on that. Of course, there are arguments against which is not true, but this is something that is discussed in the domain. Maximization of shareholders' value is a very generic term, or it's a vague term. When we say maximizing the stakeholders' value, when we mention stakeholders, it also includes the debenture holders, the bond holders, the creditors, the everyone who are just invested their money for fixed interest, right? So what is that they're going to earn? When the business is able to create wealth, when the business is able to add value to the business, what will be the benefit for debenture holders who are just receiving a fixed interest every year? And how the value of these stakeholders increased is a question mark. So wealth maximization is not really focusing on the debenture holders, on the creditors who are receiving fixed interest from the business, no matter how much ever the profit the business is making. They're kept in a separate note. They are not considered for the profit. They are just considered for interest payments. The decisions of manager to maximize wealth may lead to employees' exploitation. When the business is too aggressive on wealth maximization, the employees may be exploited. The customers too may be exploited because the business is concentrating on wealth maximization. So that is something that is criticized in financial management. Improving market share is the third important goal of a financial management. What is improving market share? Improving market share is a very generic term. Like every industry will have players within, and every player will have their own share of business in the industry. Let's say we talk about FMCG. HUL, Nestle, ITC, Britannia are leading the market of FMCG sector, right? HUL, Hindustan Unilever Limited, is leading. They have a major market share. And then comes Nestle, and then comes ITC, and then comes Britannia. And again, they keep competing for the market share. So improving market share is a very important goal of financial management. That is also important. The financial decisions taken by the financial managers should be in line with improving market share. The financial decisions taken should improve the market share. The telecom sector, Jio, Airtel, Vodafone, BSNL, right? So Jio is leading the market. They have a major share in the entire industry of telecom. Steel industry, JSW, Tata, they're leading the industry. They have the market share. Automobiles, Maruti Suzuki, Hyundai, Tata, M&M, Honda, right? So they're all the market leaders. They have major share, especially Maruti Suzuki has the major share in automobile industry in India, right? So the decisions taken by a business should improve the market share of a business. Investors can understand the market share of company through various sources, right? So how to understand the market share of a business? There are various ways to understand the market share. For example, one of the common routes is to analyze the annual reports of a business. Improving market share is the third important goal of a financial management. What is improving market share? Improving market share is a very generic term. Like every industry will have players within, and every player will have their own share of business in the industry. Let's say we talk about FMCG. HUL, Nestle, ITC, Britannia are leading the market of FMCG sector, right? HUL, Hindustan Unilever Limited is leading. They have a major market share. And then comes Nestle, and then comes ITC, and then comes Britannia. And again, they keep competing for the market share. So improving market share is a very important goal of financial management. That is also important. The financial decisions taken by the financial managers should be in line with improving market share. The financial decisions taken should improve the market share. The telecom sector, Jio, Airtel, Vodafone, BSNL, right? So Jio is leading the market. They have a major share in the entire industry of telecom. Steel industry, JSW, Tata, they're leading the industry. They have the market share. Automobiles, Maruti Suzuki, Hyundai, Tata, M&M, Honda, right? So they're all the market leaders. They have major share, especially Maruti Suzuki has the major share in automobile industry in India, right? So the decisions taken by a business should improve the market share of a business. Investors can understand the market share of company through various sources, right? So how to understand the market share of a business? There are various ways to understand the market share. For example, one of the common routes is to analyze the annual reports of a business. So understanding the size of the balance sheet is the way to understand the market share. There are other ways, like they can go to published material on companies. They can check television, they can check newspapers, right? There are various sources from which they can understand the market share through advertisements also, right? And also increase or decrease in the market share indicates the current position of the business. So if the market share of the company, let's say automobile industry, Maruti Suzuki has got major share in the industry. Whether it is increasing or decreasing is also one of the major parameter to understand whether the company is doing good or not. So that is the reason why we need to understand the market share of the business. Economies of scale. By focusing on economies of scale, companies improve the market share. So what is economies of scale? By increasing the number of units sold, they can reduce the cost incurred in manufacturing those goods or services, or producing those goods and services. So by producing large number of quantity, selling large number of quantity, they can increase the revenue for the business. So that is economies of scale. Growth in market share also grows the revenue. When the market share of a business is growing, that indicates that the business revenues are also growing. And the growing market share will efficiently manage the competition. So if the market share of a company is increasing, the competition is very well managed. The competition is, to an extent, it is reduced. So that is the importance of improving market share. So what we wanted to understand is improving market share is a very important goal of a financial management. The financial manager should take decisions, the finance decisions, in line with this particular aspect, improving the market share for a business. Now, how do companies increase market share? There are various ways in which companies can improve the market share for the business. Reducing cost, increasing the volume of sales, promotion, improving the efficiency, introducing new products to the market, customization or standardization, customer loyalty, improving the customer loyalty, introducing new technologies, talent retention, and acquisition of existing firms. There are various routes through which market share can be improved. Well, market share improvement is also not free from the criticisms. There are a couple of criticisms on improving market share, why financial management should focus on improving market share. Acquisition may lead to monopoly, right? When there is a focus on improving market share, there will be scope for monopoly or duopoly. So what is monopoly? Only one company is ruling the entire market or the entire industry. What is duopoly? Only two companies are ruling the entire industry. Right now, if you look at Indian telecom sector, there is a situation of duopoly, right? You can see Jio, to an extent you can say it's a monopoly, but it is not established because Jio is got major stake, major share in the entire telecom industry. There is also some other players like Airtel. They also successful in retaining their market share to an extent, right? So you can see the situation of duopoly, Jio and Airtel ruling the market. So that is not good because when there is monopoly or a duopoly situation, the customers will be impacted. How? There will be less alternatives because customers cannot go for alternatives. They have just Jio or they have Airtel, right? They cannot go beyond those two players because they have the major share and they are the top players in this industry. And when they have dominance in the industry, they can increase the prices because there is a dependency. People have dependency on these companies. They can increase the prices. The customers can do little about that, or they cannot do anything about that. They just need to pay and use the services because there is no alternative in the market, right? Unethical practices will increase when there is monopoly or duopoly. The unethical practices will increase, like sales, like quality drop, fake promises, service failures, or those things that will increase when there is monopoly or duopoly. So market share improvement, though it is very important for a business, at the same time, when the market share is improving, the companies need to also understand that they need to ensure the services are not compromised or the offerings are not compromised. So that is very important. And that is one of the criticisms of market share improvement. What is the scope of financial management? What is a broader perspectives on financial management? There are three important areas under which we can discuss the entire financial management. It is about financing, investing, and dividend decisions. Every business will encounter these decisions. They're supposed to take these decisions at large. Financing decisions. What is the scope of financial management? What is a broader perspectives on financial management? There are three important areas under which we can discuss the entire financial management. It is about financing, investing, and dividend decisions. Every business will encounter these decisions. They're supposed to take these decisions at large. Financing decisions. So what is financing decision? When a business is growing, when the business is too small, there will not be any need for financial resources, the financial requirements. They can manage with their own money. When the business is growing at scale, they need money, right? So how a business can access that capital, access that money? There are various sources through which they can borrow money, right? There are shares. By issuing shares, they can obtain funds. By through issuing debentures, bonds, they can go to venture capitalists, they can go to angel investors, they can go to primary markets, they can go to secondary markets, right? There are various ways they can pledge their assets and they can take loans, right? How any of these options are going to help the company is a very important financial decision to be taken by a finance manager. So what source to go, what source not to go? If the company is choosing to go for equity, the finance manager should understand there will be a dilution of ownership, right? So the owners, those who are going to invest in the company will be the owners of this business. Let's say the total number of shares issued by the company is 100. If I take 25 shares of this particular company, I am the owner of the company for the proportion of stocks held by me. That's 25% to 25 numbers. So I'm 25% of ownership belongs to me. So ownership is diluted. What if the business is going for debt or bond? They need to pay a fixed interest on those loans because all debts are eligible for interest. The bond holders, the debenture holders will get interest on frequent intervals, maybe regular intervals, maybe quarterly, half yearly, or 1 yearly, right? So the company is supposed to pay interest on those funds. No matter whether the business is doing good, they're supposed to pay the interest. So there's a drawback. Again, this is very important to go for debt or equity or any other sources like retained earnings. What if the business has certain reserves and they wanted to use those reserves to expand the business? What are the advantages and disadvantages? All these things need to be analyzed. So that is the area in which financial management comes into the discussions. Investing decisions. Investing is nothing but it is just what are the options the business has to invest in the industry. Let's say it is a telecom business. So what are the opportunities to invest? What are the investment alternatives available? And how to analyze those investment alternatives? What are the techniques that are supposed to be used? It may be net present value, or it may be payback period, it may be internal rate of return, it may be break-even analysis. So what is the technique a business should deploy to understand the investment alternatives? So what is the business, which is the business is going to give a quick cash? Which is the business is going to give us long-term returns? Which is the business is going to give higher returns with lesser risk? All these decisions are part of investing sections, investing decisions. Now, dividend decisions. A listed companies pay dividend. At what intervals they need to pay the dividend? How much in dividend they are supposed to pay? Under what circumstances a company should pay the dividend? When the business is making profits, they generally pay the dividend. When there is no profit, they're not going for dividend. Instead, they'll just maintain status quo. And when there is a profit, they'll go for dividend distribution. All these things are part of a financial management at large. Well, what are the functions of a financial manager? So, what are the functions performed by a financial manager? What all roles he will play in his designation in finance department? Estimation of capital requirement for the business is one of the very important, very critical function of a financial manager. Why? Because understanding the capital requirement, understanding the scale of business, what is the scale of business need to be understood. Then only they can make estimations of capital requirement, how much money is required. Well, what are the functions of a financial manager? So, what are the functions performed by a financial manager? what all roles he will play in his designation in finance department. Estimation of capital requirement for the business is one of the very important, very critical function of a financial manager. Why? Because understanding the capital requirement, understanding the scale of business, what is the scale of business need to be understood, then only they can make estimations of capital requirement, how much money is required. Only when they understand how much money is required for the business, they can understand where to procure the funds. Let's say the money is required to take care of short-term requirements of the business. They can understand what is the right source to go for funds. Once they understand what is the estimation of capital requirement and how to procure funds, they need to take decisions on capital structure. So I need 10 lakhs for my business debt. How much I should borrow from equity? How much I should borrow from government sources? How much I should take from public, right? So it's all very important. They need to understand how much each source. Let us say I need 10 lakhs. I want to borrow 8 lakhs from equity, 2 lakhs from debt, or 5 lakhs from debt, 5 lakhs from equity, or 5 lakhs from debt, 2 lakhs from equity, 3 lakhs from retained earnings, right? Remember, even when the business is using its own capital, that is retained earnings, when the last year they have made profit and they have retained the money, and that is also has cost. They cannot assume that it is free. There is a cost implication for the reserve, that is the bank balance in proprietor's account, right? So that is another decision to be taken by a finance manager. What is the capital structure to be for this business? A resource allocation, understanding for each section how much of financial resources are required and when is something that financial manager need to understand. Disposal of surplus. Disposing the surplus. What is surplus? It may be profit. Profit, how to distribute profit. Who will be given the first major share of this profit? How much to give? These are the decisions to be taken by the finance manager. Management of cash is very important because business also need to maintain certain cash to take care of daily activities, right? So what is the petty cash that is required to take care of daily requirements? What is the working capital requirement? All these decisions to be taken by the financial manager. Principal agent relationship in business, agency theory. So this is one of the most debated topic in the area of financial management, and it is most important areas of discussion. Often this is causing a serious principal agent relationship in business, agency theory. So this is one of the most debated topic in the area of financial management, and it is most important areas of discussion. Often this is causing a serious problem in the corporate world. Who is the principal and who is the agent in business? Basically, principal and agent relationship in business, it's a fiduciary consensual relationship between two people in the business. These two people will have their own set of duties and responsibilities. When these two parties are not able to take care of their duties and responsibilities, the conflict of interest arises, and that's when the agency problem arises in general. In a generic example, let us talk about mechanic. So, mechanic, right? How agency problem arises with mechanic. Let's say, consider you have a car and there is some problem. There is a left pulling issue in your car, and you will take your car to the garage and you will show it to the mechanic. Mechanic know that just by doing wheel balancing, this problem can be sorted, and it will just cost the owner say less than 5,000 to do that wheel alignment. Now, when the car is given to the mechanic, a mechanic is the agent, the owner is the principal. When principal has assigned certain duties to the agent, it is a duty of the agent to take care of the best interest of the owner. That is supposed to happen. When that is not happening, that is when the agency relationship, the agency problem will arise. The car is given to a mechanic and mechanic know that it is costing less than 5,000. Despite that, the mechanic will suggest the owner to go for a very major repair work or to replace some spare parts in the car, which will cost owner say 20,000. Mechanic knows that it is just costing 5,000 to the owner if that is going for wheel balancing, but still is suggesting some replacing some spare parts which is of no use. So the agency problem arises. Same with the doctor, same with the lawyer. There is just cough and cold that you can get it tested and you can take medicine, that just over the counter medicine, but still you have gone to the doctor to check. But doctor knows that it is a very common flu which can be, that can be cured with 2 to 3 days of medication, which will cost less than 1,000 rupees to the patient. But if the doctor is not doing that, if the doctor is suggesting to go for some scanning, some major medical tests which are of no use, even the doctor is aware of that. That is when the agency problem arises in this situation. Now, when it comes to a business, how agency problem arises? In business, there are two parties involved. One is agent and one is principal. Who is the agent and who is the principal in a company? Principal is the shareholder, right? The shareholders who are actually invested in the business. They are the owners of the business. Who is the agent? Agent is the board of directors or the chairman who is actually entitled to take care of the operations of the business, the entire business, because the shareholders may not be able to participate in the day-to-day activities of the business. And that is the reason they are hiring board of directors or top officials of the company, including CEO. Now, it is the duty of CEO or board of directors to take care of the best interest of shareholders. The decisions that CEO or the board of directors take should be in the best interest of the principal. Who is the principal? The shareholders. When the decisions of board of directors is not in line with the requirements of the business, when that is not in the larger interest of the business, when that is not in the larger interest of the principal, that's when agency problem arises. There are so many examples in this context. You can take Satyam case where Ramalinga Raju was the key person in Mahindra and Mahindra who actually manipulated the accounts, which is not in the best interest of the shareholders. The shareholders have not told him that to alter the annual reports to impress the society, to impress the governments, or impress the investors. It was not in the best interest of stakeholders, right? Same holds true with Mallya. When he was in the position to take key decisions to the business, when the shareholders choose him as the CEO or a board member of a particular group, he is not supposed to take the decisions that will harm the interest of the shareholders, right? There are so many cases where agency problem arises, and it's very damaging to the business. When this kind of situations arises, there will be survival question. Business may survive or it may just vanish, because when there is a compromise to the best interest of the shareholders. That is agent and principal relationship. In agent and principal relationship, agent is hired by principal and principal pay rewards to agent for the work, for the duties performed by the agent. But when the agent is not impressed about the rewards that he would expect from principal, he may find other routes to increase his financial rewards. And that's when he'll get into the agency problem. Investment banks regulated by SEBI, stock markets. Now, this is the time to understand the financial system. So, why we need to discuss about financial system when we talk about financial management of a business? We need to understand business is part of the system and finance is very much connected with the financial system. A business is a part of the entire ecosystem of a country, right? So we need to understand the financial system, how financial system of a country is functioning and how a business is connected to the financial system. A financial system of a country can be broadly discussed under three areas: financial instruments, financial markets, and financial intermediaries. It may be any country, it may be for India, it may be for any country, but these are the areas when we can discuss the financial system. Let's understand what are financial instruments. So what are the financial instruments we talk about and how these financial instruments are relevant to the business? Financial instruments are the assets for a business or for any entity. These financial instruments will have economic value. That's very important. They'll have economic value, and these financial instruments are traded in the market. It may be in the exchange or it may be in the over-the-counter market. It may be traded on a listed stock exchanges or it may be traded in over-the-counter environment. Financial instruments will have legal validity, legal tender. That's the reason these are considered as instruments, especially financial instruments. These instruments can be real or virtual. It may be intangible asset or it may be a tangible asset, tangible instrument. It may be a long-term instrument or it may be short-term instrument. It may be a long-term instrument like share or it may be a short-term instrument like T-bill, the treasury bills issued by Reserve Bank of India. Right? Now, what are the financial instruments we talk about? Financial instruments may be equity shares or debentures, bonds, preference shares, certificate of deposit, mutual fund, T-bill, or receivables, any of such instruments. But what we need to understand, these instruments can be classified into two categories, where short-term and long-term. Anything that is invested, any instrument that is traded for less than 1 year is a short-term, which beyond that is a long-term in a generic understanding, right? So debenture is traded for long-term. It's used for 5 years, 10 years, longer term. Bond, right? Debenture is long-term. Bond is long-term because it is traded for more than 1 year. Preference shares, long-term. Certificate of deposit, again, it depends, but considered as long-term. Mutual fund, long-term. T-bill, short-term. Receivables, short-term. Equity shares, long-term. Right? So equity shares are traded, equity shares are issued to the shareholders, and it will be maintained for longer duration. Now, the financial instruments can be viewed under two broad umbrella terms: money market and capital market. Money market is, as I mentioned, money market is for short term, less than 1 year. So it may be T-bill, right? It may be certificate of deposit, right? It may be promissory notes, commercial papers, bank acceptance, or repurchase agreements. Capital market, long term, debt, equity, or derivatives. Debt instruments are entitled to receive fixed interest. Equity holders are entitled to receive dividend. Derivatives, again, it's profits, right? So higher profits. Dividends, when we say derivative, the derivative may be forward contract, futures, options, or swaps. These are the common derivatives that are traded in the market. So these are capital market instruments. So money market instruments, capital market instruments. Now, financial markets. We understood the financial instruments that are traded in the market. Now, what are the financial markets? Financial markets are the marketplaces where the people or the individuals buy or sell the financial instruments. So whatever the instruments we have discussed so far, those instruments are bought and sold in the market. And this is the platform. Financial markets are the platform where we can buy or sell the instruments. What are the financial market that we can see generally? It may be a debt market where only debt instruments are traded, equity market where all equity shares are traded, primary market, that's also called as IPO, right? IPO. Secondary market, exchange traded, right? So exchange traded. OTC, over the counter market. Cash market, daily transactions, right? So daily the banks are borrowing between the banks within the group will borrow from each other for short-term requirements. So commodities market, where commodities are traded. Money market, where all short-term financial instruments are traded, less than 1 year. T-bill, certificate of deposit, all those instruments are traded in money market. You cannot see these markets in isolation in generally, because many times these markets are overlapping. For example, equity market, secondary market, a primary market, right? And money market. These instruments are traded on a particular stock exchange, right? So these secondary instruments are traded in stock exchange. Money market instruments are not traded in the stock market. They're not traded, right? They're available with the parties. So money market instruments, for example, T-bill, certificate of deposit, right? All those things. Financial intermediaries. So who are financial intermediaries? Financial intermediaries are the parties who enable trading activities. So they are the people who actually bring buyers and sellers together. They facilitate the trading activities. For example, the brokers on stock exchange, right? So these brokers enable investors to trade or invest on particular shares, to buy or to sell, and they are the intermediaries. So who are the intermediaries generally that you can see in the market? It may be banks. Why bank is considered as the intermediary? Because they borrow from those who are having excess money. They'll lend it to the people who are actually in need of money. So they come these two people together and they'll connect them. Insurance companies, pension funds, mutual funds, investment banks, stock markets, and agents and brokers. Remember, all these parties are regulated. Banks are regulated by Reserve Bank of India. Insurance companies are regulated by insurance authorities, IRDA. Pension fund is also regulated by pension authorities. And mutual fund, again, it comes under SEBI. Investment banks regulated by SEBI. Stock markets regulated by SEBI. Agents and brokers, definitely they are regulated from SEBI. What is SEBI? Securities Exchange Board of India. It's a watchdog of capital market. Security for investments in business. Now, it's very important to understand the security, how secure the investors are in business. There are various investors in the business. There may be equity shareholders, bond holders, There may be creditors. There are various categories of investors to a business. Now, the question comes, are all these people equally safe? It's very important to understand not all these people are safe, and there are priorities for each of these categories of investors who are saved first when there is something wrong with the business, when the business is approaching bankruptcy. Creditors, bondholders, preference shareholders, and equity shareholders are common people, common investors for a business. At the same time, there are various other categories of investors who actually invest in a business. Now, let us understand who is safe in the business and to what extent they are safe. What is the ranking of their investment safety? This we will understand with a simple example. It will be a very funny and interesting example to understand who is safe in the business. I hope this will help you understand who is safe, who is more safe in the business. Let us take this flight example. The flight is flying high in the sky, and it is a very reputed flight where hundreds of passengers are traveling in this under different categories of seating arrangements. Consider there is something wrong in the engine, and the flight is at risk, right? The flight is about to crash, and pilots get to know that there is some problem, and they'll announce that there is a problem in the flight, and the passengers are expected to jump out of this flight with parachutes that are provided at the exit door. And remember, there are only 4 categories of people who are traveling in this flight: first class, business class, then economy class, and coach plus. Okay, and this is the exit door. Okay, and exit door is here. This is the exit door. Now, when there is some problem with the flight, who will be saved first? That's a question. Is coach plus people allowed to exit the flight first? The answer is no, because their seating arrangement is far behind to the exit door, and those who are sitting close to the exit door are supposed to be allowed to exit first, because they can quickly exit the flight and they can allow space for business class people and then economy class people and coach plus. Otherwise, there will be unwanted juggling between these passengers, and there will be some other problem later, right? To avoid that situation, the first class people are allowed to exit the flight first with the parachute, and then the next class of people, business class people and economy class people and coach plus, right? Now, let's say there is some problem with the flight. The first class of people will jump out of this flight first because they are sitting very close to the exit door. This is the situation with the very common situation where the flight is going to crash or flight is going to have crash landing, right? Now, let us try to understand the same example in business perspective. Consider this flight is a business flying high in the sky, doing great, and it is doing fantastic, right? And the business is generating a lot of profit, and something goes wrong. Something goes wrong, and the business started declining. And there are various categories of investors to this particular business. Who are those investors? Loan holders, bond holders, preference holders, and equity holders. Now, let us consider the business is at the bankruptcy. Now that that business is going to crash, who will be saved first? Remember, loan holders are the people who will be saved first. Okay, debenture holders. When we say loan holders, debenture holders are saved first. They are allowed to exit the business with their stake. Then the bond holders, and then preference shareholders, and then equity shareholders. This is the order in which they are saved. Let us assume the loan holders, bond holders, and preference holders will get their stake, get their money back from the business, and they'll exit the business. If there is something left over, will be given to equity shareholders, else equity shareholders will incur loss. Okay, and that is the reason we say equity is risky, loans are less risky. The loan holders will receive fixed rate of interest no matter how the business is doing. Equity shareholders will receive dividend, the profit, based on the performance of the company. So when there is something wrong in the business, loan holders save first, then bond holders, and then preference holders, and then equity shareholders. So here is the quick recap of what we have learned so far in this video. Finance is all about money. It talks about cash, bank, investments, savings, forecasting, borrowing, investing, and budgeting. And there are various other aspects as well. So what are the broad areas of finance? Personal finance, business finance, public finance. Financial management is an art and science of managing money to meet predefined objectives. We have understood why it is science and why it is an art. We have understood what are the goals of financial management: profit maximization, wealth maximization, and improving market share. These are the three important goals of financial management. There are so many other goals, but ultimately all other goals will boil down to these three important goals of financial management. Then we have understood who are the stakeholders to the business. We have understood the stakeholders to the business may be internal stakeholders to the business, or it may be external stakeholders. Who are those internal stakeholders? Maybe board of directors, employees, right? Shareholders, right? They're the internal stakeholders to the business. Who are the external stakeholders? Creditors, bondholders, suppliers, customers, media, right? Society. So these are all external stakeholders to the business. Financial management. We have understood the scope of financial management. We've discussed investing activities, financing activities, and dividend activities of financial management. So finance extends to these areas. And we have understood the principal and agent relationship, agency theory. So what is principal and agent relationship? It is an arrangement where one entity lawfully selects another person or an entity to act on behalf of the principal. So agent and principal. Financial instruments, financial markets, and financial intermediaries are the constituents of financial system. And lastly, we have discussed how safe the investments in business, who faces higher risk and who has less risk in the business. So that's all in this video. I hope you all enjoyed these videos. Thanks for watching. All the best.